Hello, friends and family. My name is Carolyn Larsen-Wieber, and I am the owner and founder of CLW Financial Planning. My firm was started as an advice-only planning firm. And what that means is advice only means that I do not manage any assets or sell any products. What I've developed here is a 4-part series, Coronavirus and Market Volatility. This is part 1, but the 4 parts is on how human emotions affect the market, how markets function efficiently, how this bear market compares to other times, other bear markets in history, and finally, what are you, the investor, able to choose to mitigate downturns? So let's get started. Take a look at this photo. If you feel like you are free falling, like in this roller coaster photo, you're not abnormal. You're just simply being human. There's a simple fact that money, market volatility, and emotions are intertwined, and our emotions drive our behavior. So during this pandemic, if you can relate to this roller coaster ride, you're probably feeling anxious, fear of the uncertainty and unknown, and perhaps even panic. Fear is a powerful basic emotion. It's normal in times like this to keep cycling back to fear, no matter how hard you try to avoid it or feel better. Fear can lead to panic, especially if you keep cycling back to fear because you just don't know what to do yet. Fear is also hard to avoid. Isn't it every day we're bombarded with daily reminders in the news, in our conversations with our friends and colleagues? It's just constant. And of course, you feel like you want to do something, right? But that can lead to reactivity. And reacting without clarity or a purposeful plan, that can be dangerous. I help my clients act with purpose. Either act with purpose or just hold on tight and do nothing with purpose. Market prices are the result of the expectation of thousands of single individuals, each one having their own psychological bias. So over a short period of time frame, you actually can see the heavy influences of those biases. We know human emotions regulate stock market buying and selling behavior, and investment decisions are often driven by emotional reactions rather than rational analytical calculations. This means that having a wider perspective, meaning thinking long term, is the way investors reap benefits. So think of it this way. You have your house. You'll probably be living in your house for 40 years. And do we look at its value every day? No, but over time we know the value of our house increases. The market view is similar. And because of technology and lifespans extending, your portfolio will need to be around for your retirement, which could be 30, 40, 50 years in some cases. As humans, we use both an analytical and an emotional brain. But let's talk about the emotional side in the market cycle. So here's what happens. Over the last 10 years, we have been in this market and we just love it. It's calm and warm and we're floating around in the pond. When we get to the top, and what happens? We're actually happy. And what do we like to do? Mark has been so good to us. This is what we want to do. We want to keep on the buy. Then here comes the pandemic. And what's happening here? We're on the down market and we're not so happy. We're actually kind of sad and fearful. And what do we want to do here? We actually, emotionally, we want to sell. In times like these, now where the markets are falling, our emotions are giving us the fight or flight signal where we just want to get out of the Bering Seas. We want to sell. We're not happy. The moral of the story here, our emotions tell us to do the exact opposite of the analytical side, which is to buy low and sell high. So watching markets daily is not in your best interest. Having a wider perspective on investing is what successful investors should have. I help clients become aware of their current emotions, remind them of the wider perspective, and keep them on the plan that was developed for them, especially during high fear and anxious times like these. A lot of what's going on today is a focus of the market on a daily basis. We're bombarded by the news, by our neighbors, by emails. Everything is talking about the daily ups and downs of the market. What I'm trying to show you on the slide is the fact that if you just took one of your stocks and you were looking at it on a daily basis, 55% of the time that stock would be up and 45% of the time that stock would be down. But if you just shift to the month, which is the bar in the middle, you'll see that 63% of the time that stock would be up and 37% of the time it would be down. And then if you go even further to the right on the last bar, you have that same stock 75% of the time on the upswing and 25% on the downswing. So the longevity of investors in the market really are being rewarded for having those stocks in the market and having those stocks in the market over a longer period of time. To further illustrate my point on the wider viewpoint, let's take a look at the graph. And I'm going to draw for you what a typical stock will look like on a day. And it'll probably look something like this. But if you take the history from 2010 to 2020, over that 10-year period, and you look graphically, I can't draw that good, but the overall market for these 10 years generally was an upward trend, and you can see that the volatility in the market is a little bit more even out over those years. And you can actually illustrate the same thing yourself. All you have to do is take your smartphone, open up the market app, and take a look at a stock at the S&P 500. You can look at a 1 day, you can look at a 1 week, a 3-month and a year, and you'll see what I'm talking about. The volatility by looking at one day is kind of crazy. What we need to do is we really need to look at stocks over time, because aren't we really in it just to buy and hold? Okay, these are unprecedented times, and there's a lot of folks asking a lot of questions, and they're asking questions like, am I going to be healthy? When am I going to go back to work? Am I going to have to wear a mask at work? A lot of these questions, and they ask, are we going to be okay? And as far as my clients go and my friends and you, what I say is, yes, we are going to be okay, but we have to remember a few key things. One is, we have to be aware of our emotions, because our emotions drive our behavior. And what you don't want to do in times like this is take a paper loss and make it into a realized loss by selling at the wrong time. Also, we want to shift to long term. Remember the thing I said about the house? Remember that we're in the market, just like the time frame we're in our house, 20, 30, 40, maybe even 50 years. And also, when I've helped my clients create their plan, we do it ahead of the storm. We don't do a lot of things in the storm. And secondly, in addition to that, the plans that we've set up already incorporate these types of storms. We use things like stress testing and Monte Carlo analysis to provide some comfort that we've already incorporated down markets like this. Last but not least, we look for opportunities. In markets like this, there are opportunities where stocks are low, so that signals a buy opportunity. In addition, there's also some tax strategies that could be ripe in your situation. It just depends. So, after you've listened to this video, what should you do next? Well, if you're a client of mine, please call me with any questions that you have. I would love to help you with that. Second, take and share this video with your friends and your family. And remember, friends get a 30-minute consult complimentary. Hey friends and family, there's 2 ways that you can register to receive my videos. One, you can take the first link and you'll go directly to my registration page. The second thing, you could just go to my website, and on my website you can click the web events tab. And finally, if you'd like to schedule a 30-minute free consultation, just email me at Carolyn@clwfinancialplanning.com. I hope you enjoyed this video.